Friends, now we need to move to the third question in the exercise. You can take page number 12.53. 12.53 and there is a question of Coney Limited. Pause the video, read the question and then we will read the question once again. Okay, so let's read the question. Coney Limited, based in Kuala Lumpur, is the Malaysian subsidiary of Japan's NY Corporation, headquartered in Tokyo. So there is a Japanese company, NY Corporation, and it has a subsidiary in Malaysia. And the name of the subsidiary is what? Coney Limited. Okay. Coney's principal Malaysian business include marketing, sales and after-sale service of electronic products and software export products. Okay, and that is the product range. Coney set up a new factory in Penang to manufacture and sell integrated circuit Q50XN. So it is some product Q50XN. It is the integrated circuit products. Then the first quarter's budgeted production and sales were 2000 units. Yes. So budgeted production and sales was how much? 2000 units. Okay. Now budgeted sales price and standard cost for Q50XN were as follows. You have the standard sales price. It is given in RM. RM stands for Malaysian Ringgit. Okay. RM stands for Malaysian Ringgit. Okay, so it is a foreign currency. It's a foreign currency as far as Indian rupee is concerned. But the analysis is done by whom? Coney Limited, which is in Malaysia. So their foreign currency is what? RM. Okay, their home currency will be RM. Now, so whenever you present any calculation, it should be in RM. That is the sum and substance. Standard selling price is given. It is 50. Then standard cost per unit. Circuit X and circuit designers. And circuit X, how many units required? 10 units required. And the cost of standard cost of 1 unit of circuit X is 2.5 ringgit. Then circuit designers, you require 6 hours of the designers, and each hour is paid at 2 Malaysian Ringgit per hour. Okay, so the standard cost total comes to 37 per unit and standard contribution per unit is 13. Okay, so that is the information. Now actual results for the first quarter were as follows. Sales 2000 units. So budgeted sales was also 2000 and actual sales were also 2000 units. Production cost is given for 2000 units. Then actual contribution also given. So actual contribution and standard contribution per unit is how much? 13. So total standard contribution will be, or total budgeted contribution will be 13 into 2000. That will become to 26,000 RM. Okay, and what is the actual contribution? Actual contribution, if you see the table given, that is also 26,000 RM. Okay, so there is no difference between total or budgeted contribution and actual contribution. Okay, now the management accountant made the following observations on the actual results. In total, the performance agreed with the budget. Yes, that is what we saw. Actual contribution is equal to budgeted contribution, that is 26,000 RM or Malaysian Ringgit. Now, however, in every aspect other than volume, there were huge differences. Yes, that is the significant aspect. Okay, the final figure profit tallied, but it doesn't mean that everything went as planned. No. Except in the case of volume, there were huge differences in almost all other aspects. Sales were made at what was supposed to be the highest feasible price, but now we feel that we could have sold for RM 82.50 with no adverse on volume. See, if you see the selling price, what is the selling price here? Selling price is, total sales revenue is 158. So I can find actual selling price per unit is RM 1,58,000 divided by number of units is 2000. So 1,58,000 divided by 2000 will be 79. RM 79 per unit. So actual selling price was 79. Whereas, and it was thought that the management thought that this is the highest feasible price, which means if you quote a price which is above 79, then that will affect what? Your volume. But now they feel that they could have easily sold the same product at 82.50 RM with no adverse effect on the volume. So without affecting the volume, even if they had quoted 82.50 RM per unit, they could have achieved same volume, sales volume. Okay. Now circuit X cost that was anticipated at the time of budget was prepared, but at the time the budget was prepared was RM 2.5 per unit. However, general market rate relating to efficient purchases of the circuit X during the quarter was 4.25 per unit. So what happened was, at the time of preparing the budget, the standard cost for circuit X was 2.5 per unit, but at the time of actual period or during the quarter, the efficient price was 4.25 RM per unit. Okay, so there is a difference between the budgeted cost and the standard cost that prevailed at the time of operations. Okay, now circuit designers have the responsibility of designing electronic circuits that make up electrical systems. Circuit designers' cost rose dramatically with increased demand for the specialist skills required to produce Q50XN, and general market rate was RM 3.125 per hour, although Kony always paid below the normal market rate wherever or whenever possible. So the rate of these specialist designers, it was Malaysian ringgit 3.125 per hour, whereas how much we have budgeted? We have budgeted, say, 2. Okay, we have budgeted at 2 ringgit. Am I right? Yes. Now, what is given here? Now, in my opinion, it is not necessary to measure the first quarter's performance through variance analysis. Further, our operations are fully efficient as the final contribution is equal to the original budget. So what the management accountant is saying, that there has been a lot of changes in the activities, due to which it is not feasible for you to do a variance analysis. That is not worth. That is his first point. Second point is that the total budgeted profit is equal to the actual profit. There is no difference. Not profit, budgeted contribution, actual contribution. Okay, it is 26,000 RM. Due to which there is no significance doing any variance analysis. Budget profit is tally. Okay, so that is his view. Now what is the requirement here? Comment on the management accountant's view. Okay, you have to comment on the management accountant view with the help of calculations. Okay, now right now what you can do, you have to start solving. So first what you have to do is, you have to do a variance analysis, right? Okay, so here we will solve the question. So there are two aspects here. One is, there is a company, that company has an original budget, and during the budget period there were so many changes with respect to the cost as well as revenue. Many things changed. Okay, and there is actual result. Okay, now when you see the budgeted contribution and actual contribution, both are one and the same. So one school of thought or one argument is that since the budgeted profit is equal to actual profit, there is no need to do the variance analysis. That is point number one. Point number two, most of the items or the types of cost have changed drastically. Whether it is plus or minus, it has changed. So it is not feasible for anybody to do the analysis, because at the time of preparing the budget, the rates were something, but at the period of actual production or actual output, the rates were something different, and the actual rates also were something different. So there are different rates which are applicable for different types of cost, due to which it is not feasible for them to do any variance analysis or standard costing. That is the view of the management accountant. So first of all, you have to say whether it is a right or wrong. Okay, so I can tell you. In the given case, the management accountant hold the view that variance analysis is not significant due to the following reasons. One, what is the first reason? The first reason is budgeted profit is equal to actual profit, hence the target has been achieved. Then 2, what is the second aspect? The second aspect is there has been wide difference or wide variation in the cost and revenue structure. Therefore, any variance analysis will not give any relevant picture or any significant information. These are the 2 reasons why the management accountant says that they don't want any sort of variance analysis. However, the amount of component wise variance is computed as under. Okay, you have to do a traditional variance analysis. Now, how should you do this? You have to do this because you need to know whether what the management accountant is stating, whether it is correct or not. Okay, so let's do a traditional variance analysis first. Okay, what all could be the traditional variance analysis here? First, you will have to see the sales price variances, right? Okay, sales, first you will have to find sales variances. One is sales price variance, that is actual selling price minus standard selling price into what? Budgeted sales quantity. Actual selling price, how much? Actual selling price is how much? 158 divided by 2000. $158 divided by 2000. is equal to 79. What is standard? Standard was 50 into what is budgeted sales quantity? 2000. Okay, sorry, it is not budgeted, it is actually actual. Okay, so actual is also 2000, right? Yes, sales is also budgeted is also 2000, actual is also 2000. So that is equal to 79 minus 50 into 2000, that is 58,000 favorable. Why favorable? Selling price increased. Okay, now sales volume or quantity variance is equal to actual sales quantity minus budgeted sales quantity multiplied by budgeted selling price or standard selling price. That is equal to what was actual sales quantity? 2000. Budgeted was also 2000 into budgeted selling price was 50. So this is nil. Okay, so sales variance is sales price variance, that is RM 58,000 favorable. Now cost variance. Material cost variance. Which is the material here? Circuitex. Okay, material cost variance, you have usage variance as well as price variance. So price variance is equal to, first we will compute usage variance. Usage variance, standard quantity for actual production minus actual quantity into standard price. Okay, so that is equal to, what is standard quantity for actual? Standard quantity for actual production is, what is actual production? 2000. 2000 into 10, that is 20,000 minus actual quantity. Actual quantity was how much? 21,600 into what is standard price? Standard price is 2.50. So standard quantity consumed, that could be consumed is 20,000, whereas they actually consumed 21,600. So this is an adverse variance. Okay, and how much does it come? 1,100 into 2.5, that is 4,000. Okay, next is what? Price variance. Price variance, how do you compute price variance? Standard price minus actual price into actual quantity consumed. Standard price is 2.50 and actual price is how much? 20, it is 97,200, 97,000 200. $97,200 divided by 21,600. 4.5. Actual quantity consumed 21,600. That is equal to 43,200. Again, actual price is higher than standard price, so it is adverse. 43,200 adverse. Okay, now that is circuit X. Now what do you have to do? Circuit designers. You have, it is labor variances. So you have two variances, rate variance and efficiency variance. Rate variance is, what is the actual standard rate was 2 and the actual rate was 34,800 divided by 11,600. Is equal to 34,800 divided by 11,600. RM 3 per unit. 3 per unit. So rate variance, how do you compute the rate variance? It is standard minus rate minus actual rate into what? It is the actual. Standard rate was RM2. So minus RM3 into actual hours consumed. Actual hours consumed is 11,600. Okay, 11,600. Is it favorable or adverse? Definitely adverse because rate is higher. Now next is efficiency variance. Okay, so standard hours for actual production minus actual hours into standard rate. That is equal to standard hours for actual production. How do you get that? For 6 hours is the is there any mistake we have committed? No. Okay, so standard hours for actual production, they say that standard is 6 hours per unit. So 6 into 2000. Actual hours how much? 11,600. And standard rate is RM2. And that is equal to, it will be a favorable because what happened? the actual standard hours that they should have taken is 12,000, but they took only 11,600. So 800 favorable. Okay, now so reconciliation of profit. Budgeted profit $26,000. Favorable variances added. Which are the favorable variance? Sales price variance. $58,000. Then what else? Efficiency variance. Now less. Adverse variances. Price variances 43,200. Then you have usage variance. Usage variance is 4,000. Then you have rate variance. Designers. $11,600. $58,800. Therefore, actual profit is 26,000. Okay, so what you can conclude, even though the actual profit is equal to budgeted profit, there are various variances in most of the cost components. Therefore, such variances have to be analyzed by component wise. Okay, so you can write, though final actual profit is equal to budgeted profit, there are variances in many cost and revenue components. This should be evaluated. Okay, traditional variance. Next, traditional variance merely gives the component wise breakup of total variance. However, in order to analyze the variances better, we need to identify the reason for the variance. each component Vizier what is the first one? First reason, due to error or variance in plan or due to inefficiency or high efficiency in operation so merely because somebody says you this is the labor cost variance, this is the material cost variance, that is not sufficient. That will not help you for informed decision making. If you want to take informed decisions, what you need to know, why this variance component wise variance occurred, whether it is due to any planning error or whether it is due to some efficiency issues. Okay, so that analysis can be done only if you compute what? Planning and operational analysis. So you can write this analysis can be done only if the planning and operational variances are given, identified. Okay, so computation of planning and operational variance. Okay, now in order to prepare the planning and operational variance, you have to prepare what? First you have to prepare the original budget, then you need to have the revised budget and the actual figures. So statement of original and revised budget information. Okay, so you can have original standard. Original standard is also known as ex ante. Then you have revised standard. This is ex post. Then actual. Okay, all figures in RM. Okay, so you should start with sales. Sales, what was the original budget? Original budget was 2000 units into RM 50. Okay, then you had Circuitex. Circuitex, how many you require? 20,000 units, and for each unit you require 2000 units output. For each unit you require 10 units and at 2.5. So 2000 into 10 units. That will be RM 50,000. Okay, 2.5 into 10 will be 25, into 2000 will be 50,000. Okay, next is circuit engineer. circuit engineer, what is the standard? 6 hours per unit. So 2000 into 6 into what is the rate? RM2. So 24,000 RM. If you prepare the revised, how does it appear? Sales, what happened? It is 2000 itself. But they say that even if they sell the goods at 82.50 Malaysian ringgit, they're not going to have any volume issues or volume fall. So into 82.5, that will give you rupees 1,65,000. Okay, then what else? Next is 2000 into 10 itself. No change in the standard, but the rate of circuit X has increased from 2.5 to 4.25. 2.5 to 4.25, that is equal to RM 85,000. Okay, next is how much hours? It is 2000 units into 6 into, but the rate of the hours per hour has increased from 2 to 3.125 RM. So total will be 37,500. Now actual 2000 into RM 79. So actual 1,58,000. Then circuit X 21,600 into how much? 4.5. So total is 97,200. So this will be 97,200 divided by 21,600, that is 4.5. Okay, this you have to work out, compute. The next is total is 11,600. Total cost is 34,800. So 11,600 RM 34,800. So 34,800 divided by 11,600, that is rupees 3. Okay, so this is the revised budget. Now what do you have to do? You have to compute the planning and operational variance. So first is planning variance. Planning variance, you have to compute the planning variances. First is what? Sales price variance. Is equal to original standard minus revised standard. So 50 minus RM 82.50 into actual production was 2000, actual sales was 2000 units itself, that is equal to how much? 50 minus 82.5, 32.5 into 2000 will be 65,000. Since the selling price increased, it is a favorable variance. Next is circuit X. Is there any sales quantity or sales volume variance? Okay, 2000 minus 2000 into RM50, so nil. Okay, now circuit X price variance. First usage variance. First we will write usage variance. Okay, standard quantity minus actual quantity into what? Standard price. Standard quantity for actual production. Standard quantity for actual production is how much? 2000 into 10. Here also 2000 into 10. So original budget and revised budget, the total quantity consumed is one and the same. So 2000 into 10 minus 20,000. Is it minus 20,000? Yes, because we have already computed. 20,000 into standard price. What is the standard price? Standard price is 50. Sorry, standard price is RM 2.5. RM 2.5. So this is nil. Okay, so you can write here, since there is no variance in the quantity of circuit X to be consumed, comma, there is no usage variance. Now price variance will be there. Price variance is SP minus AP into AQ. What is SP? SP is 2.50 minus what is AP? AP we have already computed, no? AP we computed. Where did we compute? $4.50. Not 4.50, 4.25. Okay. AQ is 20,000. So that will come to 35,000 adverse. Okay, that is price variance. Now designer variance. Designer efficiency variance. SH minus AH into SR. What is SH? Standard hours for actual production. Standard hours, actual production is 2000. Standard hours is how much? 6 into 2000. Okay. What about actual hours as per the revised budget? It is also same, 2000 into 600. So and what is SR? Standard rate is RM2. Nil. Now designer rate variance. SR minus AR into AH. SR is RM2 minus AR. AR is 3.125 into 12,000. That is equal to 13,500 adverse. So that's all with planning variance. Now next is operational variance. Statement of operational variance. How do you compute operational variance? Sales price variance, sales quantity variance. You can write nil as the quantity of sales as per revised budget and actual data are the same. Okay, next is sales price variance. How do you compute sales price variance? I'm quickly writing that. It is RM 79 minus RM 82.50 into what? 2000 units. That is equal to 7000 adverse. Okay, now circuit X. Usage variance. Okay, SQ minus AQ into SR. SQ is how much? 12,000, right? SQ is not 12,000, it's 10 into 2000. So 2000 into 10 minus what is AQ? AQ is 21,600. What is SR? SR is 4.25. This is the revised SR. Okay, so this will come to 6,800 adverse. Now next is price variance. Price variance again, SP minus AP. SP is the as per the revised budget minus AP into AQ. What is SP? SP is 4.25. What is AP? AP is 4.50. We have computed here, right? 4.50. So 4.25 minus 4.50 into AQ, actual quantity consumed, 21,600. Okay, so whether it is favorable or adverse, it is adverse because AP is higher than SP. So it is price variance 5,400 adverse. Now circuit designer. Efficiency variance first. Efficiency variance. How do you compute the efficiency variance? That is equal to 12,000 is the standard hours minus what is actual hours. Actual hours we have computed to be 11,600. 11,600 into what is the standard rate? Standard rate as per the revised budget. So 3.125. That is equal to, this should be favorable because the actual hours is lower than standard hours. So 1,250 favorable. Now next is rate variance. What is SR? SR is 3.125 minus what is AR? AR we have already computed. Where did we compute that? It is 3 rupees. So 3.125 minus 3 into actual quantity is 11,600. 11,600. So that is 1,450. Is it favorable or adverse? It should be favorable because rate reduced. Favorable. Is it clear? So you can write summary. Planning variance, operating variance. Okay, planning and operating variance. Sales volume variance, nil, then nil. Sales price variance, how do you compute that? 65,000 favorable and here 7,000 adverse. Then circuit X or material. Circuit X, you can have usage variance. In planning nil, but operating usage is 6,800 and that to adverse. Now circuit X, then what else? Price variance. Price variance in planning variance, it is 35,000 adverse, but where in operational it is 5,400 adverse. Then circuit designer. The first part is efficiency variance. Efficiency variance planning is nil, whereas the other one it is 1250 favorable. Then next is rate variance. Planning is 13,500 adverse and operating is 1,450 favorable. Okay, so what is the conclusion? The conclusion is the above analysis gives a better understanding of the variance analysis. Okay, so that should be the conclusion. We are getting a better variance analysis, and if you want you can tell which are the major variances from the planning this one and the operating this one, that can be given. If you see the planning total will be how much? 65,000 minus 35,000 minus 13,500 will be 16,500 favorable. Similarly, for operating variance, it will be what? Total 16,500 favorable. So both get set off and net variance becomes 0. Okay, so there is variance, but the variance is split between the planning variance and operational variance, and most of the variance they are offset each other. Okay, so if you can remove the adverse variance, then the profit can be even further increased. Okay, so that is it. Now I think we will have to move to the next problem. Okay.